So I'm going to talk firstly about investment in infrastructure. I'm not going to say a great deal about this, but that's just one picture of why it is important that we devote attention, particularly now in the wake of the recession, to infrastructure investment. There you can see the very sharp deterioration in investment in 2009, 2010, in the wake of the recession. Business confidence suddenly disappears, private investment collapses, private investors not going to make investment decisions, and you'll see stories in the newspapers about the 500-odd billion or whatever it is that is sitting in cash piles in the treasuries of our large corporations. It's not a bad thing for corporations to have money in the bank, to have investable funds, but of course at some point, if economic growth is to be promoted, those funds need to be put to use. And so government can play something of a role in the parastatal investment programs, certainly have assisted in keeping investment going. But don't forget that something like 3/4 of investment is private sector investment. Investment by government is a fraction of overall investment in the economy, and of course the self-sustaining growth, the job creation, and from the government's point of view, never forget the tax revenues that make it possible for us to spend on public services depend on private investment. You can't really rely on Eskom or South African Airways or Transnet to pay taxes and contribute to financing government services. We try from time to time, but it doesn't last very long. So these are the numbers. You'll get a copy of the slide. You can go and look at this if you want to. These are taken straight out of the 2012 budget review, so the February budget has details and discussion of these, and it's the breakdown in our estimates of the 850 billion or so that government actually is planning to spend on infrastructure programs of one kind or another over this 3-year period. And you can see there in those numbers just how dominant the energy sector is in the actual scaling up of public sector infrastructure investment at present. Eskom, far and away the largest investor at present, and so those big new coal-fired power stations dominate these numbers. 100 billion or so budgeted, about 50 spent in 2010-11, so big lags in getting those projects going. That ratio has improved, so 73 billion or so spent last year. That was also a bit behind budget, and plans to spend 90 to 100 billion a year on those mainly those power station projects. But water and sanitation, transport is also are also important sectors. And so transport investment spending, Transnet beginning to spend a bit more, but the road spending, the National Roads Agency building these highways around Gauteng that we still don't know quite how to pay for, and beginnings of a program of reinvesting in public transport in our metropolitan areas in particular are contributing significantly to those numbers. Notice how low social sector investment spending is currently. We certainly need to do more in the hospitals and health service investment and maintenance programs, and in school building, and in beginning to recapitalize higher education. And those numbers can grow quite significantly without changing the overall structure of public sector infrastructure and investment spending, because social infrastructure investment spending is a comparatively small part of overall infrastructure spending. But it's a little harder to get going. Why? Because it's a little harder to pay for. When you build power stations that invest in the capacity to generate power that is sold to users and finance and powers up industry and mines, it in a sense pays for itself over time, although we're all quibbling a bit at the rate of increase in electricity charges. But social infrastructure has to be paid for through the tax system, and so in general it's not financed through debt and project finance and through private investment. I'm not going to spend too much time on this. There you get a bit of a picture of the sectoral breakdowns, not in this picture of that 850 billion, but of the 3.2 trillion, which was the February estimate of the total envelope of projects under consideration by the PICC Infrastructure Investment Commission. And important in this breakdown is that many of those projects are in a design stage still. And so that large column at the bottom of that graph, the projects that are in concept phase at this stage. What's the big number there? Energy, the black dominant. You can see the dominance of the energy electricity and liquid fuel sector. There are big nuclear power station plants, which in this set of estimates was 300 billion worth. We all know that if those projects go ahead, it'll be more like 900 billion or $1 trillion in investment altogether in new nuclear power stations. Well, those are still in concept design. We haven't really got hard decisions yet to make those investments, and indeed there are some alternatives to the nuclear power build programs that still have to be considered. It's partly why a commission that has the expertise to examine these kinds of projects and provide expert advice is so helpful if you're going to have decisions, particularly in controversial sectors. Thank you very much. Another infrastructure being added. But also, large parts of the PICC's plans are still in a feasibility and design stage. Ongoing programs account for a fraction, 10-15% of that 3 trillion. That 3.2 trillion number, which was the February number, is now 3.6 trillion. That was last week, next week. So it's a number that is very rough. I'm going to say a little bit about what the PICC is doing, and then I'm going to say a bit about how these things will be financed. But very important to recognize that the 850 billion number that we talk about is on budget for 3 years. That 3 trillion number, the large scale programs of investment are really 10-year or 15-year programs, in some cases even longer than that, and many of those projects are still under design. Now, what the PICC has done that I think is very helpful, and it overlaps to some extent with what the Planning Commission has done, is taken a spatial perspective on infrastructure investment. And this is just one picture. There are various versions of this kind of map. You can see how useful it is to think, when you're thinking long-term development, to think about the spatial geography and spatial plans that lie behind major investment decisions. Manganese deposits here need to reach the ports, and an improvement in the strengthening of the rail link is planned to enable manganese exports to increase. And that's a significant investment in future commodity supplies globally, but also to supplying a proposed ferrochrome smelting capability in the Kuche development zone. So I don't need to go through all of these. That's that long iron and steel line that runs down to Saldanha. But most importantly, the transport links that have to be constructed to make sure that these power stations can be supplied with coal by rail and not by road, because we are destroying this region of our country at present, having to spend 900 million rand a year just on maintaining what we call the coal haulage road network, because that's not a sensible way of transporting coal to power stations. What's happened is the power stations here can no longer obtain enough coal from the coal mines that they were built alongside, and so coal is having to be trucked from all over the place. To be perfectly frank, when Eskom renegotiated all those coal supply contracts, when there was a crisis 2 years ago, and they suddenly found they didn't have sufficient coal to keep the power stations going, they renegotiated at, in many cases, high prices, and often in a very irrational supply agreement. So there's a chaotic pattern of supply to these coal mines that has to be corrected, and the rail infrastructure investment is critical to that. But also rail infrastructure to enable an expansion over time in exports of coal. So opening up of the Waterberg is a huge part of the PICC's recommendations. Okay, so that's spatial perspective, and we can go on and on about exploring opportunities, but bringing that spatial perspective to bear on industrial development, on mining development, on how our country takes advantage of its mineral resources, but also thinking through the implications for the movement of people, the growth of cities, the requirements to supply water to cities is all part of that exercise. Now, there are 17 strategic integrated projects of the PICC. If you get a presentation from them, they will say there are 150 projects that are built into each of the into those 17 projects. So what are they? Because it's useful to bear these in mind. And you're going to hear people talk about SIP 17 or SIP 13. You're going to want to know what they are. So this is a way of organizing it. There are 5 catalytic geographic SIPs. Unlocking that mineral belt in the Waterberg, I talked a bit about that. The Durban Free State Gauteng logistics and industrial corridor, so that road has been improved. There's a grand plan for a high-speed rail. Don't expect that to happen in a hurry. It's going to be very expensive if it does happen, and it's rather a complicated terrain, and so it probably doesn't pass the tests of cost cost effectiveness, but certainly improving those rail links is important, and improving that logistics link and opening up the industrial development opportunities in that along that corridor. The southeastern node corridor development, that's essentially about making Kucha worthwhile. Great big industrial port and industrial development zone that we've built. I had a consultant go and have a look at it a couple of months ago, because I said I wanted to give some advice on how we make Kucha a viable export processing and industrial development zone comparable with these kinds of initiatives elsewhere in the world. And he went and had a look, and he came back and he said to me, "You've got a real problem there. They have built such a large industrial estate, you're going to have to plant some trees to make it look like something to hide all the empty space. So big it is." Well, there's a huge opportunity there, but it does not yet have anything other than infrastructure in place. And a few factories are setting up. Well, I mentioned the opening up of ferrochrome smelting opportunities there. That's one fairly large industry, but really the opportunities there are about more employment-intensive development. The great challenge we face there is, in my view, I can tell you what my opinions are on these things, is to get thinking away from relying on these great big projects. And Tombo is the name of a proposal for building an oil refinery in Kucha. So large that it would have to transport virtually all the refined petroleum that it would produce to the Gauteng interior, which would mean a new pipeline. Why would we want to build a new pipeline when we've just built one along the Durban Free State Gauteng corridor? So it doesn't make sense to build in Tombo. It doesn't pass any of the standard cost effectiveness tests. What we should be investing in is employment intensive industries like manufacturing expansion associated with the motor industry in that region to unlock opportunities in that region. Economic of the Northwest, not terribly clear why that is part of this geographic SIPS proposal, but and then that Saldanha Northern Cape corridor. And then there is also a clustering of investment activities and expansion and improvement in municipal infrastructure, and clearly that's tied to housing development, is tied to city development and growth, recognizing that urbanization is proceeding rapidly and we're not adequately keeping pace with the infrastructure that is needed for that. Better public transport, better urban space management, better integration and consolidation of our cities is critical if they are to modernize and create jobs and improve living conditions. Energy investment is a big part of the program, and there are 3 strategic programs that are focused on energy. Greening the South African economy is not just about energy, but it's very largely about energy, and they're an important program of attracting private investment into renewable energy plants is underway, has already been through 2 processes of inviting proposals and assessing them. And so the first major private investments in wind power, in solar power, are going to get underway over the next few years. But Eskom's electricity generation program and its investment in transmission and distribution industry capacity clearly also focused on powering the economy. And then a SIP that sits on its own, really, focused on rural development and agricultural development, linking agricultural opportunities in parts of the country where they are underdeveloped with the established commercial agricultural sectors, health and education infrastructure, and then the ICT sector, one in which South Africa has a rather chaotic policy framework and clearly opportunities to take advantage of considerable investment in ICT capacity and quite energetic firms, but a bit of confusion, to be frank, about the responsibilities of government and the responsibilities of the private sector, and so sorting those out and the respective infrastructure responsibilities of the state and the business sector is critical. The SKA, the Square Kilometre Array, the Meerkat, which is the smaller version of this investment in radio telescope capability, in which South Africa has won the right to host a very large 15 billion rand or so program, $2 billion investment in radio telescope capability. Why is it worth doing that? Why would we want to invest in astronomy? What's that got to do with job creation and development and improving people's lifestyles? Well, as an investment, most of the funding will come from the international partners, and so it's good for the economy. It brings money into the economy. But the real spin-off effects here, and those of you who have an opportunity to go and meet with the SKA people, go and talk to Bernie Fanneroff and his team. They're based in Cape Town, but they're up here from time to time. You'll see the extraordinarily catalytic effect of a big program like this on research, on technology, on engineering work, and in creating PhD opportunities and training opportunities for scientists and engineers. And it is an interesting example. This is an investment program that will last for 10, 20, 30 years. So for a long time, there's going to be major investment in the science, in the telecommunications and IT processing capacity required to operate these telescopes, and in the engineering that goes with them. And already, one of the reasons, very evident, one of the reasons South Africa won this bid is because its engineering was way ahead of the Australian engineering. So you've already got partnerships with IBM, partnerships with the global IT players, the major players in the industry, because they are doing things that are of interest technologically, globally. And so it's a good example of how science and investing in science, and often it's just an accident of history what kinds of science you happen to invest in, contributes to creating development opportunities and growth opportunities that didn't exist before. And then lastly, this recognition that we are part of a continent that is growing, the rest of the continent growing considerably faster than we are. We need to be part of that growth, and there are some very large investment in infrastructure opportunities in regional development, notably the possibility of partnering with a major investment in opening up the hydroelectric capability of the Congo River in what is called the Inga project. If that happens, then we may not need our nuclear power stations, so big is the hydroelectric potential there. But the international cooperation that is needed to get big projects like that off the ground is painfully slow and difficult to generate. So nothing happens in a hurry. Now, there's more in these slides on some of the projects underway in each of these sectors. I'm not going to go through these. You can spend time looking at them if you like. I just want to make a few points on financing, because there's a bit of alarm out there. How are we going to finance all these things? Well, the first thing to recognize is none of these projects, nothing that's been put together in this PICC's work is really new. They're building on existing plans, in many cases plans that go back a long time. Some people were surprised to find a dam that is going to be built on the Umzimvubu River as part of the PICC's proposal. Well, there are engineering designs for that dam that have been in the shelves and in the cupboards of the Department of Water Affairs since the mid-1960s. So there's nothing new here. These are old ideas that are being brought together, and in some cases given a bit of impetus, and government being what it is, a bit of a kick sometimes is needed to get things underway. And so this is a bringing together, if you like. As an analogy I sometimes use when I talk about this, this is a bit like having a helicopter for the first time and being able to go up and look at the landscape from above for the first time. And what the PICC is doing is providing that broader spatial perspective and saying that if we're going to be building cities, opening up mining opportunities in one part of the country, that has implications for water supply, it has implications for energy, it has implications for transport, it has implications for how fast cities and towns are going to grow, it has implications for agricultural opportunities, feeding into the supply of consumer markets in those areas. These are all interconnected, and you need to have that overall connected perspective on things if you're really going to get planning done properly and if you're going to get projects underway. So the PICC's work is about integrating and coordinating, and these are largely existing plans. There are many sources of finance, many different ways in which different projects are financed. The things that are more direct responsibilities of government will be financed on the budget. And as I showed you earlier, there's already 850 billion in infrastructure investment that is part of not just the budget narrowly, the things that are paid for out of taxes, but the investment plans of state-owned enterprises, some of which are financed through borrowing, some of which are financed through retained income. We've just had, remember that Eskom investment number of 70 billion last year, a 90 billion investment plan this year. Well, bear that number in mind when you look at that, what might otherwise look like profiteering, 13 billion in profit that Eskom announced a couple of weeks ago. So there's some retained earnings, equity that Eskom is able to bring into investing in its plants, in its investment itself. but a substantial part of its investment is investment through debt. Eskom's investment has always been made mainly through debt. Historically, not by raising debt itself. Historically, when Eskom was established in the 1930s, bought out a few existing power stations that belonged to the mines at the time. There was a merger of some kind, but the debt was raised by the government, and it was essentially debt that was raised by central government and loaned to Eskom. That was the arrangement that held really until the 1960s. From the 1960s onwards, Eskom operates more independently. There's a quirk in South Africa's history here. For a long time, Eskom was able to borrow internationally because of sanctions. The government was not able to. Eskom was able to borrow money internationally and able to borrow money on the capital markets generally at lower prices than government. But we got ourselves into a lot of trouble because of that in the 1980s, because the central bank at the time, in order to make it easier for Eskom to borrow internationally, underwrote the foreign exchange risk of its borrowing, and that's another story. So the financing issues can get themselves into difficulties. We've certainly made some mistakes in history we need to avoid. But you can see here how financing is about adapting the kinds of finance to the sorts of projects that are under consideration. What we will see is a growing role for our development finance institutions, of which I think the most important in respect of infrastructure investment is the Development Bank of Southern Africa. The Development Bank of Southern Africa has a balance sheet that is far too small for its responsibilities, far too small relative to the role that it has to play as a co-financier of transport investment and energy investments and even water investments. Think of when we started getting into difficulties and how we were going to finance Eskom, people started saying, well, what about the Development Bank as a co-financier of Eskom? You look at the balance sheet and it was pretty clear that it was nowhere near big enough to play a significant role. And so expanding the role of the Development Bank as a financing arm of government is going to be an important part of the mix of financing. And it's an important kind of protection. It's creating an arm of government that does lending, but does so on a systematic project basis with the kind of expertise that's needed to assess projects properly and ensure that they're properly financed, is an important kind of protection against more opportunistic, more risky kinds of finance that involve partnerships perhaps with international funds and infrastructure investors, where money is expensive, where you end up having to guarantee everything, and you end up paying a lot more than you otherwise would. So having a development bank that can raise money on terms that are close to the sovereign rate of borrowing, can partner with the private sector and get that mix of risk management that comes with good co-financing arrangements right, is critical. So you're going to see an expanded role for the development bank in financing infrastructure. Okay, I'm not going to spend too much more time on that because I want to talk a little bit about two other areas of policy. The Treasury, as you know, has some ideas about what should be done about youth employment. They're not the only ideas in this territory. So I'm going to talk a bit about that because it's something that I think remains a very critical policy issue. We are not going to succeed in financing and meeting these large infrastructure investment challenges that we've set ourselves if we don't also have a growing economy and an economy in which young people move into work opportunities and there is a greater dynamism in the creation of businesses and creation of a self-financing economy. And youth unemployment is far the most important symptom of the dysfunctionality in the present growth path of the South African economy. Youth unemployment is extraordinarily high, and there you can see the numbers. Even for people in their early 30s, the rate of unemployment is close to a quarter. So very high levels of youth unemployment. By international comparison, youth unemployment is always higher than overall unemployment. It was very rare for unemployment to be higher amongst other groups. There are a few exceptions. Singapore is not there. Singapore may well be a country where there are higher unemployment rates amongst the elderly than amongst the young. Why? Because Singapore has been so successful in improving education and skills in its economy that older people have been left behind in the jobs market because they don't have skills in Singapore. And that's of interest, and I'll say something about that in a moment. as well. Youth unemployment is concentrated amongst people who leave school before completing secondary schooling. So our large unemployment problem is not young people who are schooled or have higher education of one kind or another. Many of them find difficulty finding work or finding work that is suitable. But the big unemployment numbers are amongst people who've left school without completing secondary schooling. And here is a very, very interesting and very challenging graph. What this graph shows is that in the wake of the recession, remember that unemployment substantially rose in 2009, 2010 as jobs were shed in the context of the recession. And what this graph shows is that older workers held on to their jobs. Younger workers bore almost the entire brunt of the recession, of the loss of employment in the recession, and it has not picked up. It has not even begun to pick up by the final quarter of last year. So indexed against the level of youth employment in 2008, youth employment in the final quarter of 2011 was 80. So a huge hit on youth employment and youth employment opportunities in the recession, and the recovery that we've seen has not made a difference to that yet. So why are young people employed? Well, I could go through all sorts of issues here, and I'm sure you could add to these lists. I'm not going to spend time on that. It's an issue that has to do with our history, has to do with education, but also has to do with the structure of our economy and our reliance on industry and mining, and very limited growth in more entrepreneurial kinds of businesses and more employment intensive activity. There is a sense in which in the last decade South Africa has suffered from what is called in the economic literature the Dutch disease, suffered from a somewhat inflated exchange rate, an economy that is reliant on a commodity sector that is booming because we've had a commodity price boom globally, and so the rest of the economy, manufacturing, to some extent tourism-related services, have not done as well as they otherwise would have, and so the structure of the economy has been distorted. Persistent unemployment has a long path dependence. It's deeply embedded in structural features of our economy, the urban-rural divisions, the spatial fragmentation of our cities, unequal education and training systems, and a capital substitution bias, a bias in investment and a bias in industry that has favored more capital-intensive activities. But also, interestingly, in some research, recent research on unemployment that I'm referring to here, work published by Saldru last year, which suggests that in our unemployment discourse we don't really talk to each other. You have the macroeconomists who tell you one story about unemployment, you've got poverty and development specialists who tell you another story about household circumstances that contribute to persistence of unemployment. You have trade and industry economists who also don't talk to others. You've got those who see unemployment and labour market dysfunctionality as related to what's going on in education. They never talk to each other, and so we never achieve a properly integrated set of policy recommendations. In our policy discourse in the mid-1990s, when there was a great flurry of enthusiasm about rethinking the structure of the South African economy and the beginnings of a debate about transformation and reorganization of our economy, what the key advisors to government were saying is we don't want an economy that creates lots of low-wage jobs. We don't want an East Asian growth path. We want what was called at the time, in an extraordinary phrase, because it was accepted so uncritically, we want a high-wage, high-participation industrialization model. That's what we opted for. And we didn't realize at the time that the price we would pay for attempting to go down that route would be these extraordinarily high levels of unemployment. Because we've not created an economy that creates enough jobs, and so we have a growth path that is very uneven and very unfair. A failure to invest and a failure to grow. Again, I don't have time to go through all of this, but investment-led growth, a focus on high productivity sectors of the economy is not enough. You also need a growth path that looks for opportunities and takes advantage of opportunities in creating employment in sectors such as agriculture, like manufacturing, services, and activities that are more employment intensive. So we need many different elements to a strategy for job creation. But the Treasury thinks that we also need to subsidize employment creation in the low-wage sectors of the economy. Not because they are low wage, but because they have employment potential. In almost all OECD countries in the world, there are wage incentives or wage subsidies or forms of subsidization of employment in low-wage sectors of one kind or another. In the United States, it takes the form of what is called the Earned Income Tax Credit. The Earned Income Tax Credit is comfortably the single most important measure in the American tax code. Nobody talks about it because it only impacts on people right at the bottom of the earnings distribution. But if you earn a low wage in the American economy, the state pays through a tax credit a supplement to your earnings of about 30%. It varies from state to state. There's some differences between how states apply the federal regulations. And it has been the single most important reason why job creation in the United States economy has been so dynamic since the late 1980s. And so you've got big unemployment problems in the US in the 1970s and early 1980s. Despite this population boom associated with the baby boom generation, you have had labor absorption and unemployment brought down to between 5 and 10%, even in these times of very deep recession. In the UK, it doesn't take the form of a tax measure, it takes the form of a set of a component in the family allowances that are part of the social grant system. So in the UK, incentives, subsidies to low-wage employees are part of the social security system and the family allowances. In Poland, in Germany, in Spain, in all of these countries, especially in the East European countries which have faced such difficult transformation challenges over the last 20 years, subsidizing job creation for lower skilled and low wage workers are critical parts of their economic incentive mechanisms. I mentioned Singapore and the problems of elderly workers in Singapore. Singapore has a wage subsidy in place, not for the young but for the elderly. If you're an old worker in Singapore, the state pays a third of your wage. Why? Because, as I mentioned a moment ago, the elderly worker in Singapore is crowded out of the labour market by skilled young people. Would that South Africa reaches that stage, but it'll be 30 or 40 years before we get there, where we will need a subsidy for the elderly and not for the young. Right now, we need a subsidy to encourage job creation for young people who have limited skills. And now, Social Security reform I'm going to talk about again very quickly. It's part of that social protection package of measures that is part of the National Planning Commission's framework, but it's linked to what is needed in our job market. And I'm going to try to make a point here that is perhaps a little abstract, but it's an important part of thinking through modern employment systems and modern labour market arrangements in dynamic economies. You can't rely on the employment nexus. You can't rely on the wage system to provide all the income protection and all the social protection that households need. If a society relies too much on the employment arrangement, the employment relationship becomes congested and breaks down. And indeed, you have what exactly you can see in the South African economy is too much being expected, too much being demanded of the wage settlement and of the employment bargain. And so costly arrangements and high levels of rigidity in the labour market associated with that. Modern societies also need to put in place forms of income security and forms of social protection that operate through the fiscal system, not the labour market nexus. That's what social security reform is about. So it's very much bound up with labour market reforms and making labour market employment arrangements more competitive and more dynamic. This is, in a very simple form, the present architecture of our social security arrangements. We have industrial and occupational funds, pension and provident and savings funds. Group life is the insurance element in it in most sectors of the economy. We have statutory social security arrangements for unemployment, for compensation for occupational injury and disease. It's a bit of a messy system in which there are 5 different arrangements, one of which is completely hopelessly badly managed, 2 of which are managed in the private sector moderately well. And for 15 years, we've had a policy commitment to integrate these compensation arrangements, but nothing has happened. And we have a road accident benefit system, a very expensive one, in which lawyers are the main beneficiaries. So those are our existing social security arrangements. By any international comparison, what is peculiar there is what is missing. What is missing? What is missing is a retirement funding arrangement. So we rely entirely on industrial and occupational funds or private retirement funding arrangements. We don't have a statutory retirement funding arrangement, except for a social old age pension, which is a flat rate pension that is non-contributory. Now the difference between social security and social assistance is that the social security arrangements are contributory. They are paid for out of dedicated contributions. In the case of unemployment insurance, 2%, 1% by employers, 1% by employees, contribution associated with the wage. In the compensation funds, through a statutory levy on employers that varies from sector to sector, recognizing that construction is a more dangerous industry than working in a bakery, and so the levy on the construction sector is higher than on bakers. And the road accident benefit scheme is paid for out of a fuel levy. If we make that a simple system, we could pay for our highways. Social assistance is non-contributory. It's paid for directly out of the fiscus on the budget, and it is indeed a very large part of the budget. About 100 billion rand a year goes into the old age pension, child support grants, and various other disability grants, and various other elements in that system. So what is missing is a statutory retirement arrangement, and it's not a surprise to find that what goes wrong in our present arrangements is that very few people reach retirement with a genuine pension on which to draw. For workers and members of bargaining council funds or provident funds, it really doesn't make sense to end up at retirement with a pension. Why does it not make sense to end up with a pension if you're a low-wage worker? It doesn't make sense to end up with a pension if you're a low-wage worker, because then you don't get the grant. The old age grant is means tested, and you have to have an earnings below a certain level in order to qualify, or there's supposed to be such a means test. And so if you have saved enough to provide for your own retirement, you don't get the old age grant. That makes no sense. It makes no sense to structure arrangements in society where you discourage people from saving, where you reward people for not saving for their own retirement. So you've got to change those rules. And so one of the reforms that has to be made here is that we've got to raise those means tests, possibly find a way of abolishing them. And in fact, there is a mix of tax reforms and social assistance reforms that could plausibly and in a financially sustainable way lead to the elimination of the means tests in our social grant system. I think that would be a very attractive reform. But our present system leads to poor coverage, and in some sectors, very low coverage indeed. So there you can see how, it's not a surprise, but in agriculture, where very a comparatively low percentage of jobs are permanent jobs, so there's a lot of seasonal work, a lot of temporary work, and even amongst those in permanent employment, the percentage who have pension coverage is less than a quarter. In electricity, it's even lower, but that's because nobody is employed in these low wage levels in that sector. It's a pretty high wage sector. And you can see similarly in construction, again, not a surprise. Many jobs in construction are temporary and come to an end when projects come to an end, and so that's a sector in which there is very weak coverage. So there are gaps, and that's not a surprise. If you rely on private and occupational arrangements, if you don't have the fiscus coming in and creating a statutory savings arrangement that everybody is obliged to contribute to, or employers are obliged to contribute to, then you're going to end up with a system in which there is uneven coverage by sector. And then more specifically, even in sectors where there is a high level of contributions to provident funds or bargaining council funds. The metal industry is one where there's a fund that has membership of some 800,000 workers. Even in those sectors where there's high coverage and high contributions to funds that are managed by trade unions or managed by as provident funds or retirement funds, there is a lack of preservation. Most people end up reaching retirement having cashed in their benefits on the way. They cash in when they change jobs, they cash in and take benefits in the form of a lump sum at retirement and not in the form of what we call an annuity or an income stream. And so one of the things that Social Security reform is about is mandating preservation. Preservation of benefits is about ensuring that you still have something in your savings fund when you reach retirement and have an income. And here are some of the other elements in the objectives of the Social Security reform. It's a constitutional commitment. Our Constitution says everybody will have access to Social Security, and it's clearly a reform that is long overdue. In 2002, 10 years ago, the Taylor Committee published a report that government broadly accepted, proposing recommendations for comprehensive Social Security reform. And there has been a government committee at work for the last 4 or 5 years trying to develop proposals on this. It aims to achieve at least a 45% income replacement rate. What does that mean? That means that you try to aim for an income in retirement that is 40% of what you're earning either at the end of your career or maybe as an average of career earnings. But also, importantly, to ensure a balance between retirement benefits and other benefits, what we sometimes call risk benefits. Risk benefits comprise benefits associated with unemployment. So we have an unemployment insurance fund. One important kind of risk benefit is to provide income security against the risk of losing your job. The other important kind of risk benefit, particularly important in our society where mortality rates are high, is in protection against death or disability of a breadwinner. What are sometimes called survivor benefits, disability and survivor benefits. A survivor benefit is income replacement or an income protection of some kind to surviving spouses or children, particularly children, in the event of the death of a breadwinner. So the Social Security recommendations that we are hoping will get published once they're finalised by Cabinet in the course of this year will be broadly along these lines. So there have already been several presentations by departments involved, the Department of Social Development and the Treasury particularly, on these recommendations. So there are no surprises here, but what you're going to see is broadly these 5 or 6 main recommendations. A mandatory defined benefit pension plan, not immediately because we already have existing funds. There will need to be a transition period and an alignment between existing arrangements and the proposed new statutory arrangement. But a mandatory arrangement, that means that in law everybody employed will be obliged to contribute, and employers will be obliged to contribute alongside it to a standard package. It has 2 benefits. One is about broadening participation, but another benefit, and this is immensely important in Social Security retirement arrangements, is it has the benefit of simplification. One of the complexities, one of the challenges, one of the difficulties we all face, and the top people in finance sectors are probably just as subject to these risks as anybody else, is that the industry is so complex people don't understand it. They don't understand what their benefits are, and a standard Social Security arrangement has the big advantage that it simplifies things because everybody participates in the same arrangement. Administrative consolidation of social insurance funds. We presently have this fragmented set of compensation funds in the UIF and road accident arrangements, and there's considerable scope for consolidating and rationalizing administration there. And the Treasury, of course, is interested in the cost savings associated with that. We can get rid of the lawyers in the road accident arrangement. We will save ourselves a lot of money. And then there are important regulatory reforms that are about challenging, combating fraud and corruption, and certainly improving protection against the risks of things going wrong in the retirement industry. And I'm being told I'm very wrong.
Christians.
Yes, right. So there we go. It's there's a picture of what the system, recommended system, will look like. You'll continue to have social assistance grants as the foundation of income security, but national social security arrangement means statutory benefits that everybody participates in, private funds and voluntary savings on top of that. Right, I think that's basically what I want to talk about, except that's my concluding note, and I really just wanted to come back to these points here, that finance is not, to get back to infrastructure, finance is not the constraint here, but skills, procurement systems, organizational capacity are much more likely to hold back progress in infrastructure development. I probably am being a little impolitic there, so I want to talk about the work seeker grants and the wage employment subsidy. But the important point to note there is that in providing assistance to work seekers, you're not doing anything about creating jobs. We do have to do something about creating employment, and that's what an employer's side wage subsidy would do. And social security reform is also about important kinds of balance between the workplace and fiscal or state-funded arrangement. Right, I hope I've left a little bit of time for questions.